use bridge loans and bridge to lets to maximise profits and add value to all of my property deals. And today we're going to talk about it and I'm going to tell you how. So bridge loans can either be your best friend or they can be your worst enemy. But if you use them correctly, they can literally maximise profits that you get from all of your property deals. And stay tuned till the end because I'm going to tell you some game-changing bonus tips, and also we need to delve and talk into some of the pitfalls that you can fall into with this type of funding. As a bridge loan will allow you to add value to a property, and you can do this by doing a renovation or a deep refurb on a property. And of course, as most of you know, when you are going for a buy-to-let mortgage, unless that property is ready to go from the get-go, it's habitable and basically it's ready for somebody to move straight in, most of the times mortgage lenders won't lend and give you a buy-to-let straight away on that. So a bridge loan or a bridge to let will do just that. It will bridge that gap, allow you to do a full refurb, maximise all your profits by adding a great ton of value to the property, and then therefore you can switch and then move onto a buy-to-let portion. What is an unmortgageable property? Well, that can be literally anything from something really significant that you can see straight away, for example, significant damage, let's say like flood, fire or something like that, to something that may be a little bit more harder to spot, i.e. like non-standard construction. A lot of lenders will not lend on things like that. So some of the most common reasons for properties to be unmortgageable is if they're uninhabitable, and by that it means if there isn't a working kitchen or a working bathroom, if there's significant structural issues with the property, if it's non-standard construction. I mean, even in some cases it can be things like spray foam insulation, it can be, as I said before, serious structural issues, it can be things like Japanese knotweed being present, just the property is literally unsafe and unfit for people to be in there. And as I've mentioned before, serious structural issues, really bad cases of damp and dry rot, things like that. That will all probably bring up red flags when mortgage lenders come to look at the property. When the valuation goes through, they'll look at this and they might deem it mortgageable due to that. So then obviously your deal would probably fall through. What a bridge loan will do, it will allow you to still purchase that property, do the renovations, and then eventually move on to a buy-to-let. Or if you do get a bridge-to-let mortgage funding, then that's in almost two stages. So then you'd go through the bridge part of the funding and then you'd go on to the buy-to-let portion, so you'd have your exit strategy from the beginning. So the advantages of buying an unmortgageable property, as I've said before, it means that then you can then add value, you can get yourself a real bargain, you can also use that as a really good negotiation tactic. You're actually creating and building in profit before you've even begun to do anything to the property. That is our goal. Our goal is to maximise profits and squeeze profits as where and when we can. So obviously, in order to actually decide how much you're going to actually offer on an unmortgageable property, so you really need to know your numbers, you'll need to know your purchase price, you need to know your stamp duty if that's relevant, you need to know your cost of renovations, you need to have also a risk register and contingency built into that scope of work, so you know exactly how much, or a rough idea of how much it's going to cost to refurb that property. You'll need to know all of your finance costs, all of your other hidden costs, your estate agent costs, everything like that, all the costs involved in actually purchasing that property. If you're purchasing in a company name as well, you need to have all your legal fees figured out, because obviously if you are buying in a limited company, you'll have to have independent legal advice. You need to factor all of that in, and as I said, I've got more videos on that, so if you have a look on the previous past playlist, it will go into more detail on that. You need to obviously know your facts, your figures, your numbers, and I've got more videos that you can sort of have a look at. By the way, my name's Sabrina. I share my experience that I've had so far on my property investing journey, whether they're good or bad, and I share them all on this channel. So please like, comment and subscribe. So you need to know all of those figures, and then you need to analyse, compare and review those to what you're expecting to get the end value of the property will be, your gross development value at the end. So you need to have an idea of what the end value is going to be of the property compared to all of your costs. You want to add up the total cost of the profit, take that away from your gross development value so that you can see what profit you will get from this deal. So total cost of the project minus your gross development value so that you can see your profit at the end. So you really need to make sure that you do your homework on this, make sure that you don't overpay for the property, make sure that you know that you've got enough profit built into it, and don't be afraid to walk away from the deal. If it doesn't stack up, walk away from the deal. If the property is deemed unmortgageable, 9 times out of 10, somebody else has obviously or probably has already tried try to purchase a property, and the vendors might then become motivated sellers. So this is a real good bargaining tool for you, because obviously if you are buying on a bridge, it's almost like you're buying in cash anyway as well. So that's another bargaining tool that you can use to really drive home and get a really good deal on these properties. So in a sense, what you're actually doing is you're taking an unmortgageable property and you're actually solving the problem as to why that is unmortgageable, and that is how you're building your profits. This is how you're adding your value. This is how you are maximizing your profits from the front end of the deal. But yeah, also, as I said before, do be aware that obviously for unmortgageable properties, there's going to be a less of a demand from people to purchase these properties. They're probably going to be people that are experienced developers that are interested in that, and they might have a lot of cash buying power. But as I said, don't let that put you off, but also don't let that get you caught up into a bidding war. You're paying over the odds. And then there's also the other end of the spectrum, where somebody who may be a first-time buyer and they are buying with their feelings rather than with their head and their figures like you would be. So on the other end, don't get caught up in a bidding war as well. So that this person will probably be buying based on how they feel about the property. So they don't really care how much they're going to be paying for the property within reason. They just want that property because they're falling in love with it or something like that. So just don't get caught up in a bidding war if that is the case. Right, so how to use bridging finance, a bit more detail in bridging finance. Obviously, they are a great ideal solution to help you raise short-term funds. Yeah, so they're a great way of raising short-term funds so that you can bridge that gap. But obviously be aware as well, they are a lot faster to sort out and organise than a traditional mortgage, but I would still say the process is still quite long-winded because of all the legal requirements that you've got to jump through. And if you are like me and you're buying in a company name, that also adds a couple of elements that you've got to work through as well, because you've got to also see yourself as separate to the company. You're providing guarantor for your investment company. You've got to almost talk about yourself in the third person when you are purchasing through a limited company. So yeah, you're acting as guarantor, you're borrowing your company, the deposit and things like that, and there's also all the legal ramifications that come with that as well, and an extra cost as well that you've got to pay for. So whilst bridging, it is a lot quicker than a standard buy-to-let mortgage funding, but it's still the way the UK is set up and how it is with actually purchasing properties, and I know you've probably seen this on other content creators' videos as well. It's still quite long-winded. It's still long-winded. You can't get past that process any more than normal. It is still a long-winded way of purchasing property. It's slightly faster, but with everything that's happened in the past, with obviously COVID, with all the things that happened when Liz Truss came in, with the interest going up and down and the volatile market, it's still a lengthy process to go through. It is a lot quicker than the standard buy-to-let, but it's still a long-winded process. And also, you'll have to bear in mind as well your rates and obviously the legal fees and things that you pay to set them up, and also the actual rates of the bridge loans. They are a lot higher because it's meant to be, it is what it is, it's meant to be a short-term fix. So you should be going on there to do your renovations and then bam, off it and go and exit onto your mortgage or your buy-to-let mortgage. So your rates are a lot higher because it is a short-term lending process. And in my experience, I think most of the offers and deals and things that I've had put forward to me from my mortgage lender, they've been around 75% loan to value rate as well. So most of mine that I've managed to sort of get a deal on, they have been around the 75% loan to value rate. So yeah, bear that in mind as well. So that then means that you've got to have a higher deposit. So you'll have to have almost like a 25 to 30%. Yeah, be prepared to have a 25 to 30% deposit that you can use when you are using bridging. And I have spoke about this in my other videos as well. You really need to make sure that you have thought about how much time it's going to take for you to do the renovation. You factor that in and you add a bit more time as well. So if you are using just a standard bridge, you're not pressured when it comes towards the end of the term to exit. Yeah, so make sure you factor in enough time. So at the very beginning when you're looking at deals, make sure you've got, if you're thinking it's going to take you 6 months to do a renovation, it's always best to err on the side of caution, maybe take a 12-month, and vice versa. If you think it's 12 months, maybe take the 18-month bridge loan term, just so you've got enough time to make sure that you're doing the renovation to your standard, the way you want it, and you're not putting time pressures on yourself to hurry up and get everything done, and you're not pressured when it's getting towards the end of it it to be looking for other deals. It just saves you a lot of unnecessary pressure being put on your back. Yeah, and I would also say as well, if you are doing a bridge loan rather than a bridge to let, then make sure that you're getting your mortgage advisor to look for deals when it gets to about halfway through the term. Around that time, I think, would be a good time, so that again, you're not under pressure to be rushing around and trying to get yourself that exit strategy put in place, but then you've still got enough time to know that you've got your renovation to a certain point and you can breathe and you're more relaxed. So as I said at the start of the videos, I'm going to go through a couple of massive game changer bonuses to bridge loans. So as I've said all the way through on here, so bridge loans are a really good way of providing you with short-term funding options that can be set up really, really quickly, and most of them don't have any early exit or redemption fees. They are slightly less stringent than normal sort of mortgages. Bridge loan is more focused on the deal and what they're going to get out of it. So things like income, affordability, poor credit scoring, age restrictions. As I said before, they're slightly less stringent than actual standard mortgage funding options. All of these things are less of a limiting factor when it comes to a bridge loan, so they're slightly less stringent. Obviously, you still need to make sure that your credit file and everything like that and your affordability is as great as it can be. And as I said, I've got videos on this that you can have a look if you want to repair your credit file. It's not as strictly stringent as standard buy-to-let mortgages. So that and the fact that they can be set up so quickly, great bonuses when your property journey strategy is the way I've set mine up, which is to actually add value and through doing renovation. With bridging, it is extremely high risk, guys. It is not to be taken lightly. It can be, as I said, your best friend, and the highs are just as bad as the lows. The lows on bridging loans, you can become unstuck really, really quickly. As I said, the fees are high, the rates are high, everything is high because you are paying for convenience. You are paying for a short-term lending model. So you are paying through your nose for convenience. It is expensive. It can lull you into a false sense of security with them. You have got to be so careful with bridge loans and bridge to lets, and you have got to know your numbers, and you have to have a really, really good mortgage advisor in your back pocket just in case anything happens. You've got to make sure that you pay your bridge loan on time. I mean, this is the same through for any type of funding, but it's even more so with bridge loans. It can seriously really, really damage you and affect your credit file if you do not keep up with the loan repayments on time. So yeah, as well as having a lot higher rates, there's a lot higher fees involved with them as well. Just really, really be careful with them, guys. Make sure that you go through everything with a fine-tooth comb with your mortgage advisor so that you know what is expected from you. You know when your payment date is, what your payment dates are, you know all of the hidden costs, everything that's on there. Just make sure that you know your deal. As I said, you've got to have a really good mortgage advisor. Just be so careful with them. There is a lot that can go wrong with them. This is all from my sort of experience of the deals that I've done so far. I hope you like the video, like, comment and subscribe, because this helps push the video out to more people so that I can help more people, inspire them to get onto their property journey as well. And if you are wondering, watch this video next as well, and this just shows you tips and tricks how I make buy-to-let work for me in 2024. So yeah, guys, this is me just sharing my experience. As I said, I am not a financial advisor, so this is a quick disclaimer. I'm not a mortgage broker. Please do speak to a good financial advisor or mortgage broker, just so that you know everything on whatever deal that you're wanting to go for and you're fully informed to make really, really good financial decisions. My mortgage advisor details are in the description box below.